I passed on investing in a company, but 3 times later it came back at 8 times the valuation. That experience changed completely how I think about angel investing versus venture capital. And that one decision taught me something I've carried in to every investment since. Angel investing and venture capital may look similar from the outside, but the incentives, the psychology, and the definition of a good outcome can be completely different. Hi, I'm Rupa, Popat, the founder and managing partner of Araya Ventures and House of Araya. I remember the first time I was in a deal where I was both the angel investor with my own capital and I was deploying capital for others on the same deal. It was a strange feeling. The two perspectives are genuinely quite different. As an angel investor, I was optimizing for personal conviction. On one side, I could see something early. Do I take the risk? Do I back my instinct? Do I accept that maybe it just won't work out? But on the other side, the second you're investing on behalf of other people, the framework that you use just completely changes. Now you're thinking about responsibility, risk concentration, whether this is the right use of somebody else's capital, not just your own. In this video, I'm going to share an experience I had with a company that I saw quite early on. I had just started investing, not only personally, but also alongside a small group of investors who were following into my deals. And I remember thinking, if this were just my own capital, I would absolutely invest at this early stage, pre-seed stage. I had conviction in the founders, I liked the opportunity, I could really see the upside potential. But I wasn't yet sure, and I wasn't comfortable taking that level of early stage risk with somebody else's money. So I passed on this investment opportunity. It took 3 months, and 3 months later, the company came back into my inbox at 8 times the valuation that I had looked at 3 months earlier, and Google was now investing in them. At this stage, I invested as well. And then it took another year for the company to attract multiple Tier 1 Silicon Valley funds, and they crossed a valuation of more than £100 million. One of the new investors wanted to increase their ownership and clean up the cap table, and so they offered all of us early investors money back. For the investors in the first round, they were offered 20 times their initial investment to sell their shares. And investors from the round that I was in were offered closer to 3 times our initial investment. That experience taught me something I've carried into every investment since. Angel investing and venture capital may look similar from the outside, but what you're optimizing for, how you think about risk, and what a good outcome looks like can be completely different. And that's really what this video is about. At the most basic level, an angel investor is investing their own money into startups, while a venture capitalist is investing through a fund structure, usually managing capital on behalf of other institutions, family offices, or other individuals. At Araya Ventures, we represent all 3 of those investor groups. From the outside, those 2 things can look almost identical. You're still backing founders, you're still taking equity in the companies, and you're still trying to identify companies which have massive upside potential. But underneath that, the economics are different, the accountability is different, and the incentives are different. And once the incentives change, the behavior changes as well. And I truly believe that that's where the real distinction begins. How fast decisions get made, how risk gets weighed, and what a good return actually looks like. And what kind of company even gets them excited in the first place. I think one of the biggest differences that I have seen on how decisions get made, as an angel investor, the conviction is highly personal. You can meet a founder on a Monday, you can believe deeply in what they do and what they're building, and you can move very quickly. So by meeting them on a Monday, you could be investing in them by Friday. You don't need committee approval. You don't need the deal to fit a fund thesis perfectly. And that flexibility really matters. But when you're investing other people's money, even in a relatively small way, the framework changes. You become much more aware of downside risk, portfolio construction, fiduciary responsibility, and concentration exposure as well. What if the decision means if something goes wrong, what does that mean for the people that have backed you and your decision-making capabilities? And this is exactly what happened to me with this company. Personally, I really wanted to invest, but professionally, I wasn't yet sure I was ready to take that level of early stage risk on behalf of others. The decision wasn't really about whether I believed in the company. It was about whether I was comfortable carrying that level of uncertainty with other people's capital attached to it. And that is a very different question. I'm going to share what the data actually says about angel investor returns. And it's not the version that usually gets presented at conferences. Make sure you subscribe so that you get it when it's live. Angels and VCs are not necessarily optimizing for the same outcome. As an angel investor, if you're to get a 3x return, it can be an absolutely extraordinary result. Funnily enough, just last week, I was able to get a secondary exit in one of my angel investments at 3 times what I put into it. But when you're investing your own capital, that is a great outcome, especially across a diversified portfolio. However, in venture capital, the maths can look completely different. A fund has management fees, a fund has cost structuring, and a fund has performance fees as well. And so looking for a collection of 3x outcomes is just not the objective. We're looking for 1 or 2 companies in our funds that can return a significant portion of the entire fund. And that is a completely different level of expectation. Another major difference is that angels are actually optimizing for access in the first place to the deals, whereas funds are usually optimizing for the ownership that they get into those deals. As an angel investor, simply getting into a great company early can already be a significant win. You might be investing smaller amounts across multiple opportunities, building exposure to exceptional founders and markets before the institutions arrive. But for a venture fund, ownership percentage matters enormously because the economics of the fund depend on it. A company can become incredibly successful, but if your ownership is too small, it just won't generate that meaningful returns at the fund level. And this changes the behavior just more than people realize. Just this week, we were looking at investing in a company that I personally think is one of the most exciting health tech businesses in Europe right now. But because we're investing through our fund structure, we first had to go to our LPAC, which is the committee representing our fund investors, because the ownership we're likely to get will sit outside of our usual target range in our fund. Then after that, we also need to go through our investment committee and to our board and explain why the opportunity justified stepping outside of our normal ownership parameters. Compare that to how an angel investor might approach that exact same opportunity. If it were your own capital, you could simply decide you believe in it and invest without thinking about the ownership level, without having to run the numbers, and without thinking about what valuation you're getting in at. And that highlights another difference between the two. I feel like many of the best companies eventually also stop taking angel investing capital altogether, whereas venture capital funds get access across the life cycles of these investments. Usually, pre-seed and seed companies will take angel investors, but will shift at some stage to taking on just venture capital funds. This particular company had angel investors in their early pre-seed round, but since then, access has shifted almost entirely towards institutional funds. For angels, getting in early at some point becomes the only way to actually get into the deals. I think it's also worth talking honestly about returns, because people tend to romanticize both angel investing and venture capital in very different ways. The reality is that both can produce extraordinary outcomes, but both can also lose a lot of money. One place where angels can sometimes outperform is access to extremely early pricing. So if you can get into an exceptional company before it's become the exceptional company that drives the institutional capital in, the entry valuation can be dramatically lower. And that asymmetry can create the extraordinary returns even from a relatively small investment size. The company that I mentioned earlier shows this clearly. Investors who entered into that very first round and later sold were often 20 times their initial investment. And investors like me, who entered in the next round after there was institutional validation, had already arrived, were offered closer to 3 times. And that trade-off is that angels are usually taking significantly more risk in those earlier rounds, with the potential for even more upside. At the very early stage, most companies fail. Liquidity is limited, information is limited, and portfolio construction matters enormously. Where venture capital can sometimes outperform is through structure and scale. stronger access to later stage rounds that continue to deepen your ownership, deeper diligence capabilities, those reserves to follow on, and so ultimately the ability to build concentrated ownership in those breakout companies. A great VC fund can continue compounding into its winners over multiple rounds in ways that individual angels usually can't and wouldn't match. For example, the deal that I mentioned that we did recently, we've actually doubled down in our first fund, we've put it into our second fund because we truly believe that we want to have that level of exposure to that company. These are very different strategies with very different risk profiles, different advantages and different constraints. Some of the best investors I know understand both worlds, the value of moving early like an angel, but with the discipline that venture capital forces you to develop around ownership, portfolio construction, and risk as well. For me, I think having experienced both has made me a better investor. Early in my career, I thought investing was mostly about being right, finding the right founder, the right market, and the right company. But what I've realized over time is that it's also about understanding incentives. What kind of risk are you actually taking? What responsibility sits behind the capital you're deploying? And how the structure around the money changes behavior. And this is the real difference. I want to show you something we built specifically for investors who are already deploying capital. It's a free diagnostics questionnaire at the House of Araya. 12 questions, 4 minutes, and it gives you a personalized read on exactly where your investment process breaks down, whether that's across deal evaluation, portfolio construction, the quality of your access, and your discipline when the pressure is on. Most people who've done the questionnaire find something that they didn't expect. No pitch at the end, just an honest read on where you actually stand.